Hello friends, my name is John Locke and I'd like to welcome you to The Winning Trade, but first the required disclaimer material. This presentation is given for educational purposes only. We're not broker dealers or financial advisors and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial and please make sure you are aware of all your risks prior to placing any trades. Also note that the trades that are shown and demonstrated in the presentation and the results are from hypothetical computer simulated trades. They are believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many different reasons. For those of you who are new to us, my name's John Locke. I'm a trading performance, wealth, and success coach with Locke in Your Success LLC, where myself and my team of mentors are here to help you win in the markets and in life as well. And today we are here to bring you into the realm of high probability options trading, also known as income trading. Income trading is when we utilize option strategies to make money in the markets from the passage of time rather than depending solely on price movement alone, meaning that we can often win whether the price goes up, down, or sideways. Now, this doesn't mean we're going to win all the time. However, we are much more likely to win than if we were depending solely on price movement alone in order to make money. The strategy we're going to be covering today is a little bit different than many of our strategies. Many of our strategies are what they call positive theta strategies, and they're market neutral. And as I was saying earlier, you'll often win whether the market goes up, down, or sideways. This one, however, is actually started out as a negative theta strategy. However, it's still an extremely high probability strategy. As a matter of fact, if you take a look at the strategy's record, as we will, when we go forward from 2011 till today, its win rate is almost 90%. So although this may not be a positive theta strategy or technically an income strategy, it is an extremely high probability strategy from a historical standpoint. And that strategy is what we call the Super Bowl. Now, if you've been with us for a while, you've seen this strategy before. You've seen the absolutely fantastic results that we've had, particularly over the last 2 years. And if you're new, I'm going to give you a peek at that in a minute. But the Super Bowl is an option strategy that can be traded on the SPX or the Russell 2000. It requires a minimum of $1,000 to $1,200 in order to trade. The profit target on this trade is 100%, which is going to be approximately $1,000 on the trade size that we are demonstrating. And the exit loss trigger is also 100%, and sometimes, especially in these conditions, it's going to be technically over 100%. I'll show you what that means as we get into the strategy. But this being the case, you always want to make sure the trade is appropriately sized for your account. So this one's a little bit different than the other strategies we show here. Some of the other strategies, you can take a very large chunk of your account as far as a planned capital standpoint, and you can put that in the trade because we have exit loss triggers that take us out of the trade when things go bad. This one here does not have an exit loss trigger. We allow 100% or a total loss in the position, but as you'll see when we go along, that also has many benefits as long as you're trade size appropriately. So let's take a look at the Super Bowl guideline summary, and there are more nuances, so to speak, with the strategy, but in general, this is what we're doing. So when our monthly cycle on the SPX, we're trading this on the SPX for the example, we're going to enter a bullish call vertical in a manner where the total potential profit in the trade and a total loss are about equal. Now, there are some variations of this in the full guidelines, but generally what we're looking for is we're trying to get these equal. And then from there, we essentially do nothing for approximately 30 days. It's going to be 28 to 36 days depending on the cycle, but we're not going to look at the trade. There's no, just basically nothing to do. That's how hands-off it is. Now, when the next monthly cycle becomes 65 days to expiration, what we're going to do is we have another trade to enter. So every time our monthly cycle hits 65 days to expiration, we're entering one of these trades. So we're going to enter trade 2. At that time, we're also going to check the original trade, or what we call or refer to as trade 1. If trade 1 is up money, we're going to exit the trade. If trade 1 is down money, we're simply going to stay in the trade, and we're going to monitor that trade on a daily basis, once daily near the end of the day. And if and when that trade gets profitable, we're going to exit the trade. If for some reason it does not get profitable, we are going to let the trade expire at whatever loss it happens to be at. So how does something like this perform, or how has it performed historically since January expiration of 2011? Let's take a look and see. So here are our Super Bowl historic statistics and probabilities. Now, when a lot of income traders take a look at an option strategy, one of the things they do, and you'll know what if you're not used to trading options, then you kind of ignore this for now. But if you're used to trading income trading strategies, what a lot of people will tell you is that if you sell your short strike at, say a 10 delta, for example, for a put vertical, then you have a 90% chance of winning that strategy, which actually isn't true. So in other words, if I do a bullish vertical, and we have a trade that does that called the bull trade, where we sell a put that's about 10 delta, and of course we turn it into a vertical by buying another put a little bit lower, theoretically that has a 90% chance of winning. In reality, you have a stop out point, and a lot of times you're going to hit that stop out point more often than 10% of the time. And that's going to give you actually an effective win rate on that strategy, or a historical win rate of about 70 to 75%. And we know this because we've been trading the bull trade on the Russell for, well, since 2008, so however many years that is. And we know over all that period of time, we win about 75% of the time. We average about 20% a year if you average all those years that we've been trading it. This trade here, when we're selling an option, we're actually selling something that has only maybe a 40% chance statistically of being profitable. But the reality is, the way that we trade it historically, if you look at this since 2011 to current, we have 132 trades. We've won 117 times, or 89% of the time that we've entered this, we've actually won. We've only lost 11% of the time. And over that time, we've had a total trade for trade return of a whopping 2,578%. And again, that's with an 89% win rate. And maximum consecutive wins in a row that we've had during that time period has been 31. Maximum consecutive losses has been 3. One of the challenges that I do have with this strategy in particular is that our average loss is 2 times our average gain, meaning we do have to hold a win rate that is up in the 80% range for the strategy to be profitable over time, but that clearly is well above that, at least in the last 10 years. And if you take this all the way back to 2002, which is how long that it's been back tested in other softwares, this win rate is fairly typical in that time frame. Doesn't mean things can't change, but that's what we're looking at historically. Now, the other thing that we want to watch out for with this particular strategy is we are allowing ourselves to take a total loss on the strategy, meaning whatever we put at risk, we have the potential of losing. That being the case, you need to trade it small relative to your account size. I recommend not more than 1/10 of the size that you would trade, say, a regular bull trade. Okay, and we do that to make sure we're maintaining reasonable risk management. Now, if we take a look at the Super Bowl performance for 2021, you've probably seen this before because the Super Bowl has been featured multiple times this year. About every 3 or 4 months, I just show you three or four months of results to let you know how the trade's doing and how it has been doing. So this year for the Super Bowl, we've had a 51% return in January, a 36.1 in February, a 29.6 in March, 24.1 in April, 53 in May, 6% in June, 51 in July, 46 in August, 29 in September, 19 in October, a little over break even here in November, which is the trade we're going to be showing you. And then our December trade is still open, but doing extremely well. I will show you that as well. So how did it do in 2020 with this big market crash? Well, our Super Bowl performance in 2020 was 59% in January, 59% in February, 51% in March. We had the COVID crash. We lost that cycle, obviously. That was minus 107.1%. I'll show you how that's possible based on the way we do the numbers. When we look at the trade, in May we had 15, in June we had 13, in July we had 56, August 27, September 47, October we about broke even. In November we were 27.6, in December we were 51.1 for a total trade for trade return of 300.6%. If you adjust this, and what I do is I adjust this to compare the yearly return with the other strategies we do. If you adjusted it, you divide it by 10, and that would be 30.06% in 2020. So we're actually doing a little bit better this year than we did in 2020, and the strategy both years has just performed fantastically well. So I'm just really super excited about it. Now, let's take a look at the trade. And I'm actually going to start with our September trade. So let me go back in time here. Let me look at the T-log. Let's go to, we'll take a look at September, October, November, and we'll take a little bit of a peek at what's going on in December here. So if we look at our September cycle, since we start 65 days to expiration, our September cycle is actually going to start on July 14th. Now we are going to get more recent, right, because we're going to go through 3 trades. So stay tuned here. What we have on the Super Bowl is we have the asset price here at 43.77. We have the date, July 14th, 2021. We have the asset, the SPX. What we're going to do is we're going to go in with our long strike slightly above the money. Generally, we would like to start this at 43.80. And then we're going to go 20 points higher, and we're going to sell our short strike a little bit higher than that. Now, what we're looking for is a 1-to-1 risk-reward ratio. In other words, risking $1,000 to make $1,000. In some implied volatility markets, that's fairly easy to do. As a matter of fact, sometimes we make $1,200 or $1,400 with only $800 risk. In other types of markets, like this market here with the implied volatility skew, we're a little bit opposite of that. We are risking a little under $1,200 to make a little over $800. But regardless, what we're doing with our planned capital is we're calling our planned capital $1,000. And this is just a way that we can figure out our returns on a consistent basis over time with the same position size. Okay, so that's the way that the returns are figured, and this is how, in some cases, we can actually lose a little over what we would call 100%. So here we are with this trade. We are 65 days to expiration. What happens with this trade is absolutely nothing until our October cycle, which is 93 days to expiration, becomes 65 days to expiration. So that's about 28 days. So we're going to sit in this position for 28 days. And that's 1, 2, 3, 4 weeks. And 28 days later, you can see that our October is 65 days to expiration. Our September trade is up. So our profit and loss down here, $298 on our $1,000 planned capital. And since it is up money and we're opening our new trade, what's going to happen is we're going to close our September and we're going to open our October. Now we would open the October even if the September was down, but since the September is not down money and it's up money, we're actually going to close on September 1st, close that out. And I'm going to give you the exact same trade setup for the October cycle. Again, we come in here, we try to get our 1-to-1 risk-reward ratio. Now we're only going to go so far over the money here. If you do start getting too high, a lot of times the risk-reward ratio, first of all, doesn't really increase a whole lot. And if you start getting too far away from the money, your probabilities start to drop off a little bit. So it does actually matter where you enter these. But anyway, this would be our entry for October. And this is an example too of how simple this trade is to manage. We had put on our September trade. We did nothing for 28 days. We came in 28 days later. We checked it. Hey, we're up money. We exit the trade. So that's pretty nice. Same thing here. I come in. I'm 65 days to expiration. I put the trade on. I don't have anything to do to this for 28 days. That's just a waiting period for the trade, or at least until the next cycle which is November, is 65 days to expiration. Now November is 100 days to expiration, so 65 is actually 35 days. So we're going to go ahead 35 days. So here we are, 35 days later, and currently what is happening here is The asset price is up to 44.83, and you can see that we are up money here. So what we're going to do, since we're up money, we're going to close this October trade. Again, first trade you put on, nothing for 28 days. Second day trade you put on, nothing for 35 days. Now we close this trade, and now we're going to open up our November trade. And it's the exact same process again here, nice and simple. We are coming in, our asset price is 44.83. We end up coming at 4,500 in this case. We're trying to get our risk-reward ratio of 1 to 1. Again, the implied volatility skew is not allowing us to do that, but that's okay. And we do the best we can with what we have. We enter this trade, nothing to do for, well, let's see, the December cycle is going to be 93 days to expiration, so nothing to do for another 28 days. So let's go hop ahead about 4 weeks here. So the 13th of October. And here we are. We open up our software because December 65 days to expiration. It's time to check November, and we find that November is down. Oh my goodness, we're down money. $747. Now, that's a lot when you have a planned capital of around $1,000. But the wonderful thing about this strategy is it's long term, so you have a lot of time for the market to work in your favor. And the second wonderful thing about it is you don't stop out. Now, if you go a standard bull trade, or if you're doing a very far out of the money bull trade, your risk reward ratio is such that you have to have an exit loss trigger or a way to stop yourself out. Otherwise, your risk reward in the trade becomes irresponsible, and you lose so much money on a trade you're never going to make it back up. But the reality is with this type of trade here is that we can take a total loss on the trade, and chances are we can make that up in 1 or 2 cycles. And everything is back to normal, everything is fine. So here, the market's been down. As a matter of fact, I think it was even down more than this at one point. The market was all the way down to 4,300. If we take a look at that on our risk profile graph, that's all the way down here. So we were drawn down nearly $1,000 at one point. But like I said, you don't do anything, you just wait it out. So from here, now that we are down money, we're still going to enter our December trade. But we have time. We have another 37 days. We're going to wait and see if this trade actually gets back to neutral here. Now, this trade gets a little bit more active because now I'm looking at it on a daily basis. But all I'm doing is I'm opening the software, and if the market went up, and I'm seeing if I am profitable here. So not on the 14th, not on the 15th, not on the 18th, but bam, on the 19th, we are actually positive. We get back to break even here. That being the case, we are going to exit the position. Now, I realize you're not making a lot of money, and of course, if you're subjective in this, you can stay in and see if the market ends up going higher, which if you did, it definitely would happen. But according to the strategy guidelines, we would exit here on this day, and we would move on to our December. So I'm going to go back to where we would have entered December, which is right here on October 13th. Again, our entry is going to be pretty much the same as we've been doing before. We're at 46.31. We're going to be about 43.70, 43.80, and we're going to put on our bullish vertical, try to get a 1-to-1 risk-reward ratio. You can see we're getting a little bit better now. With that, we're a little bit closer to 1-to-1 on this cycle. Again, now we're a little bit more active because we're checking our other trade once a day, but not terribly active. And as of right now, January is 100 days to expiration, so we're going to be in this trade for 35 days, and at least 35 days, and we're going to see what's happened. So how is the December trade doing as of right now? Well, it's actually doing quite well. So let me just go to live markets here. And you can see as of right now, our December trade is up $613 on our $1,000 planned capital number, and this is due to be exited when our January is 65 days to expiration, and that's going to be next Wednesday. So that is the performance of the Super Bowl over the last 4 months. It's been absolutely fantastic. As a matter of fact, if you take a look at the last 2 years, let's take a look at how many trades in a row this has won. So let me bring up our 2021 results here. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 trades without a loss in 2021. And we have 1, 2, 3, 4, 5, 6, 7, 8 trades without a loss. So that's 11 and 8. That is 19 trades in a row without a loss. And December looks like it's going to be positive as well on a trading strategy that is extremely simple and returns fantastic results. And that, my friends, is the Super Bowl, this episode's winning trade. If you like what you see, we encourage you to go to thewinningtrade.com, that's thewinningtrade.com, and discover how you too can follow along with this and many other great strategies as they unfold during our weekly trade update webinars called Options Trading for Income. That is a weekly webinar that we hold for our Go members. Another great thing about going to thewinningtrade.com is you can learn about upcoming winning trades and explore past winning trades. And we often have bonus materials when we release videos that you can use to get more information on each of the strategies. Another cool thing is you can receive access to our Trading Success Blueprint, where you can see the procedure we use to help traders become profitable in the markets. And then, of course, there's the Trading Performance Podcast at tradingperformancepodcast.com. And there you can learn the mental techniques that will help you skyrocket your trading, regardless of the type of trading you do. If you have any questions, comments, or anything else you'd like to see on the next winning trade, please make sure you post that in the comments, and I'll answer your questions for you personally. Thank you for joining me, and I look forward to seeing you on the next winning trade.